Kevin Green, senior markets correspondent with me now. What levels are you watching here on Wall Street?
Good morning, Nicole. We're seeing about 50% of the stocks in the S&P 500 so far in the green, but we are still seeing that defensive positioning when you're looking at the makeup of sectors that are in the green right now. It's utilities, healthcare, and consumer staples, among other sectors as well. So that rotation trade seems to still be into effect. And when we're kind of looking at the levels, that actually may be a little bit of a big deal when you're looking at the intraday action for today. The 6,400 level is going to be your first area of support. We were able to actually defend it yesterday. You're looking to have some buyers really try to step in if you're a bull in order to defend that level, and then trying to get back up to around that 6430-ish area, which is going to be your first major area of resistance here. We see this channel that did develop over the last couple of trading sessions. We talked about it yesterday morning where we actually broke through that 6440-ish area. That was kind of that catalyst for this move to the downside here. And if we're seeing any type of further breakdown between the 6400 level or so, let's say 63.95, your next area of major support is going to be 63.70. So right now the path and the trajectory is still kind of to the downside here, but you still have that rotational trade taking place. You're not seeing net overall outflows coming out of the market where you're selling every single sector right now. This just seems to be, once again, kind of selling, maybe taking in some profits when it comes to communication services and technology, putting them into a little bit more of a value trade, which is actually normal this time of year. This is one of those things that kind of has come up over the last 24 hours, is the fact that August and September are usually very difficult months and volatile months for the S&P 500. We've actually diverged from that trend over the last couple of weeks here, so it's not surprising that you do see a little bit of a pullback as we kind of gear up for Jackson Hole Fed meeting and then for the holiday rally potentially at the end of the year.
Yeah, I see healthcare, real estate, energy, financials leading the way here as far as sectors, none of which are up in a big way, but showing at least a little bit of strength here today. There's maybe a little bit of a wait and see mode on what we might hear from the Fed minutes or Jackson Hole, for example, and tech and communication services and consumer discretionary slightly lower. You're also watching utilities. Why is utilities important today?
Yeah, so we actually look at this utilities and tech ratio, if you will, and compared to the S&P 500, that really gives you the general trend of how the market's really faring so far. And over the last, let's say, month and a half or so, we have this kind of consolidation pattern with this ratio. That's going to be in orange. As we see that line move to the downside, that means that utilities are actually outperforming technology. And if that orange line is moving to the upside, that means technology is outperforming utilities. And usually that's conducive for the S&P 500 to move higher just because of the overall weighting as well as the speculative nature of the technology sector as a whole. But if you kind of look at this trend over the last month and a half or so, we are still actually making lower highs on this ratio. You don't want that to actually happen for too long. We had the same type of situation happen in December of 2024 for about 3 months before we saw the formal breakdown in early February or so here, where that line was obviously making lower highs as well as lower lows on a relative basis before the overall breakdown. So right now, utilities defensive, still outperforming the high growth or technology sector as of right now, and you just don't want to see this trend continue, say, for another 3 weeks or so. That could also create maybe more downside pressure for the overall S&P 500, which, once again, going back seasonally, is normal and to be expected. And actually, if you look at volatility, it's actually still pretty cheap given the environment that we are in right now. So those that are concerned about their portfolio, Nicole, can still go out there and hedge and purchase hedges at a pretty cheap rate compared to what we usually see in the past, where volatility is sitting at around 17.5 or an 18 VIX around this time.
Yeah, understood. Understood. What about what's going on with the NASDAQ 100? I mean, yesterday was a tough day for the NASDAQ. While the Dow was hitting intraday highs, we were just looking at Palantir for a moment ago, how it's 20% off its highs. Some of these tech names have been taking a bit of a beating of late. What do we think about some of the trends in the NASDAQ 100?
Yeah, so you are seeing a breakdown in the NASDAQ, but if we look at a longer term time frame here, what you are still seeing is higher highs as well as higher lows. Until you break that 22,640-ish area, the trend is still to the upside and a trend shift is not really being identified. Now, the oscillators at the bottom of this chart kind of tell you a little bit of a different story, that you got to be a little bit cautious here. MACD still above that zero line, but the 12 EMA is below that 26 EMA. That is actually a bearish formation. And RSI, it appears to be making lower highs as well as lower lows. So that's something to also be mindful. There was a bearish divergence, meaning that the momentum in the price action represented in RSI was actually kind of moving lower as prices in the NDX was moving higher. And usually you'd like to see a correction of that trend, and that's occurring pretty much right now. If you look at a bounce at 22,640, that would be completely normal. Now, unfortunately, that's probably another 5% from where we are at right now, or that would be a total of around a 5% to 6% drawdown from the high to low. But what you really get concerned about is if you break that level, then we still have this open gap that we saw back in May 12th or so, that could still be tested. So higher highs, higher lows, Nicole, still a bullish trend until that actually changes here. Let the technicals kind of lead you and guide you instead of emotions. And right now, emotionally, a lot of people are on edge, but technically the trend is still strong, and you don't really see a rotational trade if we're going to have a major breakdown, a 15 or 20% breakdown in the markets. That usually just signals that we have a cooling off period, a 5%, 6% drawdown before we're trying to make new all-time highs here.
Yeah, and also we've been watching the 10-year bond yield somewhat steady, and the dollar, which has sold off over the last 6 months, has also found a steady footing. Your thoughts on why these levels, I mean, just have found their place, but what people are watching for in particular?
Yeah, so this is actually very interesting. If we look at a 3-year weekly chart, you are seeing there's a strong correlation between the dollar and the 10-year treasury. We have the dollar in blue on this chart. We have the 10-year treasury in white. And you can see that very strong correlation. And usually we don't see a break or divergence of that correlation for too long. And right now it's starting to get pretty stale that we have the 10-year still at an elevated rate compared to where the dollar is. So what you would like to see is actually a closing of that divergence, either yields moving to the downside, which the market has been anticipating and is hoping for with the Fed rate cut. That might be a little bit difficult, but that's what the market's hoping for. Or you actually see the dollar starting to strengthen up a bit. And the dollar trend right now, it's been able to hold this 98-ish area. Maybe we have another move to the downside, the final flush for the dollar in this whole cycle here, but it is trying to hold up. You're looking for that divergence to actually come align a little bit more than what we've seen over the last 2 months or 3 months, just like we would see in the past. So something to kind of keep on your radar. Obviously, everybody's going to be focusing on it. It's just very interesting with the dollar, just really quickly, Nicole, it's really interesting with the dollar what's going to happen. Traditionally, the dollar will continue to break to the downside as the Fed kind of cuts rates, because usually that's a signal of economic weakness, and the dollar's based on a relative performance compared to other countries, but that might not be the case this time around. Who knows? I just think that there's this divergence that's going to be corrected one way, shape, or form, and looking forward to seeing how that actually develops here over the next couple of months.
All right. Thank you so much, Kevin Green. Great to see you.